Talk. Welcome to Your Net Worth in Focus, a video series committed to answering your personal financial planning questions. Today we are discussing vacation rentals.
Hi, everyone. I'm Rebecca Hammond. Thanks for having me today.
Thinking about buying a vacation home, you may want to consider a mixed-use property. These are properties that can be used for both personal getaways and short-term rentals. It's a great way to enjoy your vacation home while potentially offsetting some of the costs with rental income. Here are some things to remember. If you use the property personally more than either 14 days or 10% of the total days it's rented out, the IRS still considers it a residence. This means you'll need to separately track the rental income and expenses from your personal use for tax purposes. However, if you rent the property out for 14 days or less a year, generally you aren't required to report the rental activity. This can be a big win if your vacation home is in a popular area, especially during peak seasons or events like the Masters or the Super Bowl.
When you rent out your vacation rental, a portion of your usually non-deductible expenses become tax deductible. To claim these expenses, the IRS requires you to separate and track expenses between rental and personal use. You will report the rental income and deduct the rental portion of those expenses on your Schedule E. These expenses typically include utilities, maintenance, repairs, insurance, mortgage interest, real estate taxes, and even depreciation. Basically, any expense directly related to earning the rental income. Certain personal expenses, like the personal portion of real estate taxes and mortgage interest, may be deductible on Schedule A if you're able to itemize. The main thing to remember is you can typically only deduct the portion of expenses that relates to the time the property was rented out.
Remember, tax laws can be complex, especially for vacation rentals. The Tax Cuts and Jobs Act, TCJA, of 2017 may impact the deductibility of your personal use expenses. The first noticeable change was limiting the deduction for state and local taxes, which includes property taxes, to $10,000 a year.
In addition to this, the interest deduction related to acquisition debt was limited to $750,000 for those who filed married joint. This was reduced from the previous limit of $1 million. Acquisition debt refers to any mortgage used to finance your vacation rental property. It can be secured by your primary residence, a second home, or taken out specifically for the vacation property itself, including its purchase, construction, or any major improvements.
It's important to note that these TCJA provisions are set to expire at the end of 2025. Depending on the outcome of the upcoming elections and legislative priorities, tax laws related to vacation rentals could change. We recommend staying tuned for updates after the elections in November.
We have glossed over some complex tax laws and regulations in hopes of simplifying this information for our viewers. For more details on the tax laws related to vacation rentals, please see our related article on our website, www.katzabosch.com.
Tax laws can be complex and vary depending on individual circumstances. Please consult a trusted tax professional for specific advice on your vacation rental.
Thank you for joining us today, and be on the lookout for more of our videos answering your personal financial planning questions.